Hey everybody, Signet here with the Bullish Bears. I wanted to do a brief introduction into the butterfly trade and talk a little bit about the benefits and perhaps the thoughts behind when we would want to use a butterfly. Now, there are a lot of different strategies that we employ the butterfly on. We got intra-week strategies, expected move Friday strategies, and then we've got our longer term strategies. And the butterfly is also one that you can skew sideways to perhaps protect yourself if price was to overrun your position. A butterfly is really only profitable at or near expiration. And so a lot of times it's not necessarily the fact that you need price to get to a certain point. It's the fact that you need price to get to a certain point at a certain time. And if you give that some thought, you might realize the difficulty behind not only having a position where you think price will be in the future, but at what time it will be there in the future. So on the screen here, we've got your typical butterfly. I put it on in SPY. It's $5 wide. Right now, SPY is trading for 289, and you can see that I put on a call butterfly because I'm looking to position myself above the market. Now, whether you're using puts or calls, you always want to buy the butterfly. Um, there is no strategy that I could talk about that would use a butterfly that you sold. And so if you notice, all these positions are green. They are all uh, trades that we would buy. And what we do is we sell the body of the butterfly and we buy the wings. And you always want to remind yourself of that when you're trying to put one of these on. Sell the body, buy the wings. Sell the body, buy the wings. The reason we call it the body is because the one that we're selling, there's actually two options there, and then we do one above and one below. If we was to break this trade apart, you could see that we're buying a call and selling a call. That makes a spread. And then we're also buying a call and selling a call, and that makes a spread. And those two spreads combined give us our butterfly. So here on the screen, we have a call butterfly, and I've used the call because I am again above the market. If I wanted to use a butterfly below the market, I would buy a put butterfly. Again, doing the same thing, sell the body, buy the wings. So in this example, we need price to be within this tent at or near expiration. Now, if you get to this spot very early, this green line is a really good representation of what you could earn, and you could see that there's no value in the trade because time hasn't passed yet. As time passes, it will start to form this shape where the red line is. Now, the problem is it really won't take that form until pretty much the day, maybe two before expiration. And then on the day of expiration, it'll really start to creep into this. And if you play chicken with the market and wait until the very end of the day, right before market close, you could hit the most profitable time frame. Now, you can't hold the butterfly into the close. You can't hold it into expiration because if price is straddled here at the center of your butterfly, you'll have options in the money and then you will be assigned your position. So we never can hold the butterfly all the way to close. But you can be the most profitable if you're in the center of the tent and you play chicken with the market, waiting until the very end of the day, closing out moments before the market ends. The problem with that is that if you don't get filled in time, you will end up being assigned those shares. So let's look now. Oh, before we flip through here, when would we want to do this? We always want to look at the ways that volatility will help or hurt us. So in a call butterfly that we buy, um, our advantage when it comes to volatility would be getting a decrease in volatility. All right. So in this, getting vol crushed will help your position. So now let's look at the put side. And again, the same situation. I went $5 wide. I am below the market, so I want to use puts. sell the body, buy the wings, sell the body, buy the wings. You can see that it's not very expensive compared to the other one, right? One of the really nice things about a butterfly is that it's a low probability trade. And when you are entering into a low probability trade, the potential for reward is really high. So you notice that our max loss here is $23, and yet even if we're even $2 from price, we could double our profits in that trade, right? We buy it for 23, we sell it for 54, just from being $2 away from our target. And you can see that at the target, very near to expiration, we could hit somewhere around 450, maybe $460 if you wanted to play chicken, right? So um, these trades are the type that you could lose perhaps 4, 5, or 6 times in a row, and then on that seventh one, you could make up all of your losses and then some. The typical intra-week butterfly trade strategy that I've developed, our first target profit goal is 300%, and um, that is a pretty good trade reward, considering that most of the time I aim for a 45-50% target profit in most of my typical spreads. Now, one thing about the butterflies is you can see, like right now, I'm below the market. SPY is at 289.31, which is this gold line here, and the center of my butterfly is at the 285. So I would need price to fall. The problem here is if I get overrun, if it comes down to where I want it to be, and then it continues to move against me, then I'm completely at a loss here. I'm underwater. My options are in a bad spot, and there's ways that you could kind of hedge yourself in the marketplace. If you suspect that the market could take a really good strong move to the downside, you could look to put on a different type of butterfly, in which case you're trying to protect yourself from getting overrun in the market. So here's an example to where um, let's use the put one first, since we were already on that. So here's an example of we're below the market, and say we just don't know for sure that we're going to get that strong move to the downside and end up in our butter zone. Now you can skew this from either direction. Right now I have it skewed to the top, so you can see that if price was to climb from its current position, I won't take a loss over here, right? At expiration, I would make around $26. Now that's not great, but it's not a loss, right? So that's an acceptable position. We're either going to not lose money if the market rallies, or perhaps make money if it fades back into our position. We could skew this the other way. If we're more concerned about the market completely overrunning us, we could put this um, hedge on the other side just by moving which set of options gets the ratio. Perhaps something like this. I have to unlock it for it to appear correctly. Kind of scrunch everything together. And so this, you can see that if the market was to fade but run past our position, then we would still be profitable on the downside. That's a really nice thing about butterflies, is we can recreate it in a way that gives us protection. Now what it also did, if you didn't catch this, is it took all the risk that was here in the butterfly and it put it down here. So there is still risk in the trade. Remember that when we were looking at our typical butterfly, then in a typical fly we just have capped risk on each side, and it's not too horrible. It's right. It's the amount that we paid. Here we took all that risk from one side and threw it over and combined it. So now if the market was to rally with this position on, we would certainly be looking at a good loss here. choosing which way to build your butterfly really comes from taking some strong technical analysis and determining where your risk is. Is your risk in a market that could possibly rally, or is your risk in a market that is getting ready to sell off and you're worried that it might sell off harder than you anticipated? So you can protect yourself from either direction, right? And again, that can be done with calls or puts, and it really just depends on where you're going to put the body of the butterfly. Since SPY is at 289, if I was going to build my butterfly ratioed or straight, if I was going to build my butterfly above the price, I would use calls. And if I was going to build my butterfly below the price, then I would use puts. So the butterfly does give you an opportunity to hedge your portfolio and to perhaps protect yourself. What it also does, though, is it gives you an opportunity to put on a low probability trade. And there really is a time and a place for those low probability trades because they have a very high turnout. You can also leg into a butterfly if you need to correct a debit spread or perhaps protect yourself that you're already in a spread and you just want to straddle price with another one and build yourself a legged in butterfly. There's a lot of different possibilities that you can do with this trade and a lot of ways that you can make money in the market. All right, a lot of times we're looking at a binary situation where we're either going to win or we're going to lose, and we either need price to stay put or to move in a specific direction. But with a butterfly, you can actually win when a multiple of those happens. You could win if the market stays put, you could win if the market rallies, and you could perhaps not lose if the market only fades at a certain point, right? And that gives you so many different choices and different ways to look at the market and decide for yourself what type of trade are you interested in building and how can you apply that to the current market conditions. So hopefully you enjoyed this introduction to the butterflies. We do have the full butterfly trade strategies on the Bullish Bears website. I look forward to seeing you in the next video. I appreciate your time.